morning, everybody. Thanks for your time this morning. I'll start with GARDA Diversified, the REIT. So look, the theme here, I guess, is the REIT's delivered in line with expectations for FY16. Funds from operations were about 9.7 cents and distributions of 9, giving us a payout ratio of about 93.5%. Valuation increased through the year of about 9%, which saw about a 10-cent increase in NTA to $1.13 at 30 June. Total return for investors that participate in the IPO was about 22% for the year. Importantly, that distribution of 9 cents, about a 9% return for the year, was 45% tax advantaged in terms of building allowances and the like. The results, valuations, every property in the portfolio increased across the board. As I say, about a 9% increase in total. A combination of factors that brought those valuations through. So a little bit of cap rate compression, a little bit of completion of capital works programs, and increase in market rents. Through the year, there was a capital management program in terms of an on-market buyback. About 3.5 million units were purchased back at an average price of 97 cents, whereas I say at 30 June NTA closed at $1.13. Through the year and at 30 June, gearing sat around 30%, about 6.5 times interest cover, and had a bit under a 2-year duration left there. The debt at that point in time was fully fixed and hedged out for another 3 years to run. As Fiona mentioned, there was an acquisition which we settled on late last week, about a $30 million industrial shed, 12.5-year WALE leased to a company by the name of Blackwoods, which is a wholly owned subsidiary of Wesfarmers. Now, Blackwoods itself has been around since the late 1800s and is a very substantial business its own right. Blackwoods is business to business, industrial safety, and a very substantial business. That building was acquired at about a 7.75% yield and has minimum increases in rent for 3% per annum for the next 12.5 years. Just jumping back to capital improvements, we invested about $2.75 million in the portfolio through the year and expect to see slightly more than that running into FY17. The vast majority of those funds have been directed into the Cairns asset and also to the Box Hill assets, both of those properties being near enough to 30 years old. Leasing during the year, about 10% of the portfolio, about 4,500 square metres of the portfolio was released during the year on a weighted average term of about 4.9 years and weighted average increases of about 3.6 years. So that's in excess or better than the portfolio average as it would sit. Post the acquisition, the distribution of assets is about 80% commercial, now about 20% industrial by value. And that's probably a weighting we'd like to see increase further this year as greater acquisitions in that industrial area. That acquisition was fully debt funded. St George Bank is our financier, and that's taken our gearing to a little over 40%, about 42% gearing. Interest coverage was still about 4.5 times. The new debt's taken our weighted average term to maturity out to about 2.25 years. The debt that's been drawn down, this recent $30-odd million, is not fixed; it's running variable, whereas the first 45-odd million from last year is fixed out for another 3 years at this point in time. Key objectives looking into next year is really tenant retention and leasing and the conclusion of the material capital works program, and then obviously keep an eye on capital management initiatives to bring gearing back to our preferred target in that low 30% range. In terms of outlook for next year, distributions for GDF will increase 4.5% to 9.4 cents on current price of about $1.05. That's a 9% distribution rate. Again, 45% tax deferred was the rate last year. And payout ratio, importantly, is only about 84% of fund from operations at that higher gearing level. Gives us the ability to potentially raise capital by various methods in the future to reduce gearing and still maintain that 9.4 cent distribution rate. So that's the GARDA Diversified Fund. As Fiona probably mentioned, GARDA Capital Group, the manager, listed also in July of this year. It's also released its accounts, albeit for the pre-listing period. I think the couple of highlights there, just in short, EBITDA for the year is about 1.65 million, which is about a 15% increase on the prior period. The assets under management for the group grew about 30% from July 14 through to the current period. Clearly, the acquisition of GDF recently is a good component of that, plus the uplift in vals in that period of time. So GARDA Capital Group now listed, nice clean balance sheet, very limited gearing, and about a 30% increase in AUM. Look to see that continue into this particular year, and can see various methods that AUM increase coming through, as well as a continuation of those debt activities as well.